Have you ever wondered what stocks are and how they work? A question that has undoubtedly crossed the minds of many, especially those who are just starting to dip their toes into the vast ocean of investing. So, let's unravel the mystery. Imagine you're at a bustling market, not the kind where you buy fruits or clothes, but a different kind of marketplace, a stock market. Here, instead of apples or t-shirts, you buy and sell pieces of companies. Yes, you heard it right. Pieces of companies. These pieces are what we call stocks. And when you own a stock, you essentially own a slice of that company, no matter how big or small. But what does it really mean to own a piece of a company? Well, it means you become a shareholder. You're not just a customer or an observer anymore, but a part owner. It's like having a seat at the table. Your voice matters, and you may even get a say in the company's major decisions. Now, you might be thinking that sounds great, but why would a company want to sell pieces of itself? Good question. Companies issue stocks primarily to raise money. Instead of borrowing from banks or issuing bonds, both of which require them to pay interest, companies sell stocks. This way, they get the funds they need to grow and expand, and in return, they share a part of their success with their shareholders. So, stocks are more than just numbers on a screen or tickers scrolling at the bottom of a news channel. They're a way for everyday people like you and me to own a piece of a business. They give us the opportunity to grow our wealth alongside the companies we believe in, and they allow us to participate in the economic growth of our society. So, in essence, owning a stock means owning a piece of a company. It means sharing in their successes, their failures, and ultimately, their potential for growth. Now, isn't that an exciting prospect? Why should you consider investing in stocks? Well, the potential benefits are quite compelling. One of the main attractions of stock investing is the possibility for long-term capital appreciation. Simply put, this means that the value of the stocks you own could increase over time, potentially providing a handsome return on your investment. But that's not all. Stocks can also provide income in the form of dividends. These are a share of a company's profits distributed to its shareholders, often on a regular basis. This could be a useful source of passive income, especially for those looking to supplement their earnings or plan for retirement. Lastly, owning stocks allows you to participate in a company's growth and success. If you've ever fancied having a hand in the corporate world without the day-to-day grind, owning stocks can give you a slice of that action. Investing in stocks can provide numerous benefits, including the possibility of financial growth. However, like any investment, stocks come with certain risks. It's vital to understand that the world of stock investing isn't all sunshine and rainbows. The prices of stocks can be as changeable as the weather, swinging up and down due to various factors from company performance to global economic conditions. This volatility can sometimes lead to investors losing a part, or in extreme cases, all of their initial investment. Moreover, the stock market isn't a get-rich-quick scheme. It requires careful planning, patience, and a strong understanding of the market dynamics. This is where effective risk management comes into play. It's about making informed decisions, not just following the crowd. Diversification, or spreading your investments across different types of stocks and sectors, is one effective strategy to mitigate risk. In essence, investing in stocks is a balancing act between risk and reward. Awareness and management of these risks are key to successful stock investing. How have stocks performed historically? Well, let's take a journey down memory lane. For decades, stocks have been the belle of the ball in the investment world. They've danced to the rhythm of economic growth, and despite occasional stumbles, they've proven their endurance. If we trace the footsteps of stocks over the long term, we'll find that they've outperformed many other asset classes, including bonds and cash. Yes, the stock market has had its share of highs and lows, but it's the long-term trajectory that matters. And that trajectory has generally been upward. Think of it like a roller coaster ride. There are thrilling climbs, terrifying drops, and even some heart-stopping loops. But at the end of the ride, you're higher than where you started. That's the story of stocks, historically speaking. It's also important to remember that past performance does not guarantee future results. The stock market is influenced by a myriad of factors, from geopolitical events to technological advancements, and even public sentiment. That's why it's crucial to stay informed and make well-thought-out investment decisions. So, what's the takeaway here? While stocks can be risky and volatile in the short term, they've shown resilience and strong growth potential over the long term. They've weathered economic storms and navigated through uncertain times, emerging stronger and more robust. Historically, stocks have been a strong investment choice. What role do stocks play in your investment portfolio? Let's dive into it. Stocks are the growth engine of an investment portfolio. They provide the potential for capital appreciation, which is the increase in the value of an investment over time. This appreciation, coupled with dividends that some stocks provide, can significantly contribute to the overall return of your portfolio. But just like a car engine, your portfolio needs the right balance of stocks to run smoothly. Too many stocks might make your portfolio volatile, subject to the ups and downs of the market. Too few, and you might not reach your financial goals within the desired time frame. So, how do you strike the right balance? That's where your financial goals and risk tolerance come into play. If you're saving for a short-term goal, you might want to limit your exposure to stocks due to their volatility. On the other hand, if you're investing for a long-term goal, like retirement, a larger allocation to stocks could potentially provide the growth needed to reach your goal. But remember, everyone's financial situation and goals are unique. It's important to review your stock allocation regularly and make adjustments as needed. Consult with a financial advisor or use an online robo-advisor to help guide your decisions. So, stocks can be a vital part of your investment strategy, but always remember to align your stock investments with your financial goals and risk tolerance. Stay tuned for part 2, where we'll continue our 101 stock market guide and dive deeper into the guide of getting started. If you enjoyed this video, don't forget to give it a thumbs up and hit that subscribe button. Your support means the world to us, and it helps us create more content you'll love. Thanks for watching, and we'll see you in the next one.